over and over again, the existing portfolios we review for new clients are just leaking taxes. And worse, the client had no clue this whole time until we told them. So in this video, I'm gonna walk you through the 3 biggest causes of leakage that we see, and I'll share with you how we fix them for our clients. Let's get right into it. So first and foremost, why does this seem like a continuous, ongoing issue that we come across? Well, first and foremost, we find that advisors are focused primarily on pre-tax returns, but what really matters is after-tax returns. What actually hits your pocketbook, what you actually keep. That's what truly matters. We also find that advisors do not take the time to understand your tax situation. So they're not investing in a tax-aware or a tax-smart manner. There's no tax lens being put on the way that they're advising. We also find that they're not often independent. So their firm actually requires them to use certain products. Believe it or not, there's a strong correlation between their firm making money and tax drag. So the first mistake we most commonly see is something called capital gain distribution. Now, capital gain distributions are this phantom tax. They're income that you have to pay tax on, but you didn't get any money out of the fund. You just got a tax bill. You typically will commonly see these in mutual funds, where the mutual fund manager is buying and selling throughout the year, and they push those gains out to you, the owner, the client. The problem is you didn't get any money in return. You just got a tax bill. And these can go on for years and years and years. And then you get landlocked into these funds because you have too many gains because it has grown. Now you can't get out without a tax bill. And ongoing, you have this tax bill. I'm going to show you actually a real life example of someone that we brought on recently, and this is what they experienced just last year. And unfortunately, they've been experiencing this tax bill for years. And now we have to get them out of this. So what you can see here is here's all the funds that were kicking out, both long-term and unfortunately short-term capital gains are even taxed higher. And these are capital gain distributions. These are different than I pulled money out and I owed a capital gain on that, or I sold something and I owe a capital gain on that. This is actually happening within the fund, embedded inside of the fund, triggering these ongoing taxes. This client had $33,000 of phantom income show up on their tax return, and that's been going on for years. And why people don't really realize this is happening is it shows up on their 1099, they give it to their CPA just plugs it in, and off everyone goes. So that leads us really into mistake number 2 is active trading. And we see that happen really in 2 forms. One is through mutual funds that I've been talking about. The other is stock picking. Here's the reality of mutual funds. Mutual funds, you're hiring this portfolio manager inside of the fund to buy and sell on your behalf. You're hoping that you're going to get performance above the index, but what we typically find is there's this ongoing tax drag through the capital gain distribution, but we also find is the expenses are generally excessively high. Here's an example of actually one of the funds from the list I just showed you that were paying all those capital gain distributions. This fund has a 0.83% operating expense. That's roughly 4 times what we like to see. 0.2 to 0.3% is healthy and normal. 0.83% is excessive. Here's the other unfortunate reality about mutual funds. Not only do they generally have this ongoing tax drag and higher expenses, historically speaking, they have not actually even beat their index. There's many different studies that have gone down this rabbit hole, but I really like this one. I think this one's really simple. This is actually done by the S&P, and they just show over 50% of the time historically, the typical mutual fund is going to underperform the S&P 500 index that it was supposed to be beating. Now, there's always going to be outliers, but to us, it's concerning that on average, it's going to underperform, cost more, and have this phantom tax drag. So the other active trading issue that we typically see is stock picking. And then stock picking is usually underperforming as well, but also that typically forces short-term capital gains instead of long-term capital gains, which is taxed almost double for most of our clients, as well as they typically will miss out on dividends, and then what dividends they do earn get what they call ordinary dividend treatment rather than qualified dividend treatment, which is a great lead in to my third point, the third leakage that we commonly see, which is poor dividend treatment. the client is receiving dividends in a tax inefficient manner. Dividends get one of two tax treatments, either ordinary or qualified. Ordinary is generally taxed at their top tax bracket plus the Medicare tax. So for a lot of our clients, they're taxed upwards of 40.8% on their ordinary dividends. Now, on their qualified dividends, they're taxed almost half, on the top end, 23.8%. So naturally, we want as many qualified dividends as we possibly can. So let me show you a really neat example. This is from a client's actual tax return that we clipped out, where you're gonna see that last year they made $125,000 in dividends, but we were able to get 91,000 of that to be treated in a qualified manner, which for them was almost half the tax by getting majority of that to qualified tax treatment rather than ordinary. So it matters a lot. In this client's situation, it mattered over $10,000 of tax. It's year over year. That really compounds. The other fun little thing you'll see on theirs is they actually earned $15,000 of tax exempt or tax-free interest. And that's really a good lead in to what is it that we do for our clients that's different, that we're doing to try to prevent as much leakage as possible. We're trying to reduce the tax drag as much as possible. Here's three really simple strategies that we use. One is ETFs. Now, ETFs are great because we can buy a diversified set of holdings in a much lower cost manner on average than mutual funds, and they generally do not have that ongoing capital gain distribution. They have different tax treatment than mutual funds. Second, we really like direct indexing. We use direct indexing, especially in that client scenario where they were stuck in those mutual funds and we have to figure out how to get them out of that. Direct indexing is a really powerful way to invest because we're actually going to go buy the stocks individually. We're going to buy the index directly. That might mean we're buying the S&P 500. We're actually buying individual stocks. We're not buying the fund. That creates a ton of leverage for the client, both in being able to manage taxes, but also manage what they're actually investing in. We're able to create ongoing, there's these tax losses that you get to harvest out that we can then use to help reduce tax drag in other parts of the portfolio, especially when they have existing holdings that we're trying to unwind. And the third is municipal bonds. I showed you the example of the client earning $15,000 of federal tax-free income. Municipal bonds are really powerful when used correctly, and for a lot of our clients can be a huge income, tax-free income source that has less volatility than the stock market. That's just three examples. Naturally, we are building out a highly personalized and bespoke strategy for each client based on their situation. So how do we quantify the benefits of tax-efficient, tax-smart, tax-aware investing versus just not caring about taxes, being tax neutral? Here's a model to show you that if you invest $1 million over 25 years and you have 7% pre-tax return, but you have 2% tax drag versus a 0.8% tax drag, what does that do for us long term? Well, it's $1.1 million in this example. I start with $1 million, but at the end of 25 years, I have $4.5 million or I only have $3.4 million. So tax drag is this silent performance killer that can cost many people 6 figures or even 7 figures in their portfolios long term. So driving investment costs down, driving tax costs down has a compounded benefit that can mean a fortune difference. All right, we walked through 3 mistakes that we must always see investors making, this leakage. Then I gave you some thoughts of how we do it. But if you want a personalized plan built for you that's centered around your specific situation, click the link in the description below. Book a strategy call. I look forward to meeting you then. See you in the next video.